Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Dominic Rinaldi.
Welcome back. I'm Dominic Rinaldi, host of the M&A Unplugged podcast. I've been fielding a ton of calls and emails from clients about the lending environment for acquisition loans. So today we are being joined by Doug Adams of Emerson Capital. Doug is a loan broker that specializes in helping people secure SBA loans for their acquisitions. SBA loans can be a great resource for deals requiring a loan of less than $5 million. Doug is an expert in the SBA lending field, having sourced hundreds of loans for clients. One of the big advantages of Emerson Capital is that Doug works with about 18 banks across the country. So he will have a bank for just about every type of transaction and situation. In today's episode, you will learn how deals are getting financed when the revenues of a business have been impacted positively or negatively, what the banks are looking for during underwriting, how to think about deal structures and value when looking to buy a business during this COVID period, and how to think about developing projections on a go-forward basis, something that all of the banks are going to require. But before we get into today's episode, if you want to avoid common deal pitfalls and the risk of losing substantial dollars, you need to know how ready you really are to buy a business. Because I believe proper preparation is so critical to your deal success, we have published several free resources to help you be better prepared. You can access these resources on our website at 𝐾2advisor.com/resources. That's K2advisor.com/resources. Being prepared is critical to ensuring that you maximize revenues and minimize risks. Thank you for being here, and I know you are going to get a ton out of today's episode. Hey, Doug, welcome back to M&A Unplugged.
Thank you. Thank you for having me. Happy to do it.
Yeah, so glad to have you here. You know, this is an important topic. I've been fielding a ton of phone calls and emails from clients and prospective clients about what the market's like, but also how the banks are handling M&A transactions and lending these days. And as you and I both know, it's an incredibly robust market right now. And the short answer is the banks are lending.
Right.
It's a little different, but the banks are still lending. And thankfully, you're a loan broker, so you have like 18 banks in your portfolio that you work with, you know, depending on the deal, the size, the industry. So what are you seeing and hearing from the banks?
Well, so you're absolutely right. The banks are still lending. And, you know, when COVID first came out and we had the stay-at-home orders and the lockdowns and all that, the banks were trying to find their way, and the underwriters were learning, and the credit committees were learning, you know, how they should approach this, and you know, were scared, for lack of a better word, when it initially sort of, you know, fell that way. They since, and that was in March, April, May. Since then, they've kind of found their footing. And are lending. They're looking at a few different things, though, as they look. You know, as you certainly know, SBA loans are all about cash flow, and the historical cash flow in the business. Is there enough for the debt service that will result from the acquisition loan and maybe a seller note, and allowing for some household cash flow needs to be taken care of. So that approach is still the same. And the wonderful things about the SBA deals for acquisitions, you know, the low down payment, the long term, the good rates, those are all still in effect. But they have tweaked their process a little bit to more closely analyze the revenue and the cash flows in 2020. So as you know, the banks are all about the last taxable year, and was the cash flow from the taxes with the add backs that are appropriate sufficient? And now they're looking much more closely at the internal numbers than the year-to-date numbers. And this, this is an interesting thing because many businesses, as we know, there have been a number of businesses that are thriving, that this has been a decent environment for them. But there are plenty that aren't, a lot that aren't.
It's almost like a tale of two cities, right? You have these businesses that are almost experiencing embarrassing riches as a result of COVID. And then you have on the other side of the ledger, businesses that are just experiencing so much pain.
Yes.
It just depending on what industry
it totally depends on the industry. Yeah. And the ones that I guess halfway in between there, where they were, revenues were way down in the lockdowns and the stay-at-home period of April, March, May in there, and now they come back. And so that group, I mean, it's pretty easy for the banks to look at the ones that are thriving and say, hey, cash flow, or the ones that are just doing horribly and say that, we can't do this deal now because there's not enough cash flow. But that middle ground is the interesting ones. And so when you look at a year-to-date profit and loss statement, it may not be looking as though it has the last few years, and a lot of that might be because in that 3-month period there from March to June or July, they were way down, but now they're coming back. And so this is interesting, and the banks are willing to look at this and understand that and take that for what it is, as long as they can get comfortable that it's back to normal, if there is such a thing, or that the numbers are enough to be annualized, based on the last 3 months, as opposed to, that second quarter.
Yeah. So let's stop there and break that down for a second. So if you were a business, whether you're an owner of that business or you're a buyer looking at acquiring that business, and the business suffered some downturn, but now between, maybe June and November, the business has started to ramp back up, coming out the other side. What you're essentially saying is the banks will almost give you, to use a golf term here, a mulligan on those months where you were down, and look at what the pre-COVID scenario was, and now maybe how your rebound looks. And if you're on track with pre-COVID revenues, the bank is now willing to, potentially lend on that business. Is that correct?
Yeah, you're absolutely correct. And so what they're doing is they're requesting monthly breakdown of the profit and loss statements for 2020. Mm-hmm. So they're going to want to see a P&L statement for each of the months of this year. Maybe even compare them to the months of last year for seasonal businesses, and look at and see, the types of things, that illustrate that rebound. So they have something to hang their hat on, and then they'll go a little deep, with these internal months that were down. Were employee or staffing costs higher? Did the company have to spend more money in personal protective equipment or cleaning, or supplies, or overtime for employees? So all those things kind of come in the mix. And
Doug, are you saying that when the bank looks at those things, they're willing to give the business credit because they're considering those almost one-time expenses or extra, ordinary expenses?
Yeah, I think that they will.
So you can add it to cash flow. So if you spent, $50,000 on personal protective equipment, they're going to look at that and say, that would have been cash flow to the business, and we're going to consider some or all of that as cash flow. Yeah,
I mean, every bank's approach is a little bit different, and as with the PPP loans. So as we've seen, when these companies, a lot of companies took in the PPP loan money, did they put it into revenue? As you look at these statements, a lot of businesses did that. It's not necessarily wrong. I mean, it's not according to GAAP, but if it's going to be forgiven, then it's cash to the business. And it sort of offsets the lower revenue that was happening, or the higher employee costs during that period of time. Yeah. So each bank will look at this stuff in their own way. But the bottom line with that is, has the business come back? And if it has, they're not going to penalize you for the year-to-date numbers not being high enough.
And okay, so that's great news if you own a business and you want to sell right now. So if your business is rebounded, you've got maybe a path to exiting the business with what would have been your pre-COVID value or close to it, maybe. What
Close
does this
to it,
mean
maybe
for
not the same.
what does this mean for a buyer, though? So I'm a buyer, I'm a prospective buyer of that same business, and I might have some concerns, right? I mean, so I'm walking into a situation that is fluid, right? Or we're already in the midst of another outbreak. Who knows if it's going to dip again? How should a buyer be thinking about that? And what is the bank saying to buyers about that?
Well, I think the approach that the buyers should take is similar to what the underwriters are should be looking at and are looking at, and that is what does the future hold? If you can determine that the business has stabilized or is back or historically had stable cash flows, went down for a period, and now it's back. If you can analyze those monthly statements and get a comfort feeling that this business is back where it needs to be, then you should gain enough confidence to go ahead and do those deals, especially if you've got the historical trends and historical cash flows, and it's pretty evident that this was attributable to the stay-at-home orders, lockdowns, and all the things that have gone with COVID.
Right.
The key on all of these, I mean, the starting point when you're looking at any of these is the revenue. Has the revenue stayed stable? Has it gone up, down, by how much? Where are we today? What are the prospects for the future? And then everything else comes off of there. And if the cash flow is a little bit lower, even though the revenue was stable, it might be, and you have to get below and into the numbers, is that because of increased employee costs, PPE expense, things like that.
Yeah.
So you just got to get underneath and really analyze what is behind all the.
Well, and I think that's a really good point, though. So let's dive in a bit. So you're talking about get underneath, right? So you obviously, if revenues are trending back, good sign. It's enough if you're an owner of a business to sort of engage a professional to say, hey, can I take the business to market? And a buyer to say, well, maybe this is a potential acquisition I should be looking at. But it's diving under the hood of that car, right, to really figure out what's going on. So what are some of the finer diligence things that people need to be analyzing? I mean, for example, what you and I were talking offline, you had mentioned things like AR. What's happening in a company's aging from AR? Because yes, they might be producing the revenue top line, but what's happening to their receivables? Is their underlying customer base healthy?
Right. Well, there's no question. And then again, these underwriters are going to be doing this as well, and they're going to ask for not just the last AR aging that we have in the past been sufficient for the banks. They're going to want to look at the monthlies. And has there been a trend? Is the AR increasing? Is it where it was last year at this time, if it's a seasonal business or not, and then look at the amounts of the AR associated with your various customers. Do you have a concentration? Is the customer base diversified enough, or is there a concentration risk with one of those customers who may be having their own cash flow issues, and that they had never been over 90 days before or ever over 30 days, and now they're over 60, and looking very carefully at that kind of stuff. And I think you as a buyer should be doing the same thing. You want to know, what is your risk that your customers and your suppliers, for that matter, is this business able to get the supplies that they need? Are there any hiccups in the supply chain? Are there vendors operational, and are they getting the supplies that they need on a timely basis? So right. If you could, get at these kinds of things too, it would help you understand the numbers even more so.
Yeah, I mean, these are all good points. These are things that people really need to be analyzing in addition to the top
line.
And
I will add one thing too to the accounts receivable aging is the general liquidity of the business. Does this business operate with a line of credit? How much is that line of credit? What do you need as a buyer going in? What will be sufficient for you so that you're in the safest position? And one of the things that, during this period, the SBA has really tried to promote the banks to lend. And so they put in programs, and they had a program for a while that paid 6 months worth of payments for every existing SBA loan and every newly booked SBA loan through September.
Yeah.
So that, you know, people felt a little more comfortable, and the banks felt more comfortable, and they were more eager to lend, and buyers were you know, happy to take advantage of that. Some of those programs may continue. It's been sort of at a standstill here while the election took place. And now as the dust settles a little bit, they may come back with some more of those types of programs. One of the things that they also included in the CARES Act was the express line of credit for these SBA deals. Historically, the maximum unmonitored express line of credit was $350,000. The CARES Act raised that up to $1 million for businesses to put in conjunction with their 7A SBA acquisition loan. So, you know, they're just addressing, they want to make sure that they're giving these businesses the best chance of succeeding. And that $1 million limit on the express lines of credit is set to expire at the end of this year. And again, the hope is that they will extend it. We just don't know yet. But those are the kinds of things they're looking at.
Yeah, you know, and Doug, you're hitting on such an important point, lines of credit. You know, the buyers will often ask me, you know, if there are pitfalls in buying a business, what are some of them? And lines of credit, working capital is so often overlooked. And it's in my top 10 things that people need to consider. You know,
I agree.
Okay, you might get the business at the right price. You might get a great loan package. It might be doing, but do you have enough liquidity in the business to continue to run it for some period of time? You know, especially when you're looking at most of these deals are asset deals, so you're not walking into the accounts receivables of the business. You're starting from a clean balance sheet, and so, and it's great that the SBA is signaling this is important. You need to think about this. We want to make sure you remain healthy, and so these programs have been awesome.
Oh, there's without a doubt, they want the banks to continue lending. They need these small businesses to thrive. Yeah. Just as an example, we had a flooring business that was approved a little while ago, and we had put in a $350,000 line of credit. The banks came back, and as part of the commitment letter, they, in conjunction with this discussions that we had, decided to raise that to $750,000 line of credit. So you can imagine, I mean, this customer, this buyer was very happy to get that. Yeah. You know, whether you use it or not, you know, if you don't need it, great. But it's just an illustration of how willing the banks are to put you in the most possible position to succeed.
Yeah, look, and knowing that that line of credit is there is, you know, amazing. Like you said, you don't have to draw down on it, but having that security, that insurance policy is a great thing, especially right now. Yeah, not knowing you really, you know, what's going to happen, right?
Well, yeah, and then, you know, and it's not just for maybe an expected downturn in revenue, but do you have to wait longer to get your supplies? You know, are your costs increasing? You know, what you mentioned about if you're not buying the accounts receivable, well, it's 30 days before you're going to start to get money in. So you still got to, you know, pay your employees, lights on and all those things just to get going.
Yeah, and sometimes 30 is optimistic. I mean, you could be 45, 60 days, right? To get through a complete cycle. So really, really important.
Yeah.
So Doug, we've focused a lot on when a business hasn't done so well. Let's take the inverse of that. We are seeing some businesses that are doing really well, and owners, right or wrong, are looking at this as an opportunity to maximize the value of their businesses. Right. Some of them are experiencing 200-300% increases in their revenues and their net profit. And I mean, look, they're coming to us every day wanting to know if their business is worth, exponentially more. And the challenge with that is you don't know if that's the new normal for a business, or they've just experienced this nice uptick because of COVID, and where it's going to settle out. So how are the banks, how are you advising owners of businesses in regards to value expectations? And then for buyers, where, an owner, wants to get that extra value, how can they bridge a gap potentially with that owner?
So as you know, the price that a business sells for it could be that it's a 3 multiple on the cash flow, or a 4 multiple, or a 5 multiple, and depending on the industry and the history of that industry, that will guide you in some aspect. But if you are looking at a business that is really thriving this year because of the effects of COVID has stimulated their business, and the owner says, well, I think my business is doing more, and the question is, how temporary is that? Is that the new normal? What can be expected in the future? And really, it's all about the future expectations. Having said that, though, there are some mechanisms in place when you do these SBA loans, besides your own due diligence and what you feel is going to be the future. The bank underwriters are going to still underwrite these loans, and the requirements and the rules for SBA loans dictate that the historical cash flow has to cover the debt service. So you can't get too carried away with a valuation that's higher than it has been historically, because if you're looking at the last taxable year and starting with that net income and the appropriate add backs, you still have to have the proper debt coverage. In addition, as part of every SBA loan, as you well know, there's a valuation. And the valuation comes during the closing process, and these valuation companies are going to be putting realistic values on the businesses, and they're going to use their own people to analyze what does the future hold? What is this business really worth? And I don't think you can get too crazy, even though things are doing well, but it really has to be sort of sustained for a while. And maybe that is a new normal, but we just don't know that yet. It's just too soon.
Right. And so there's one other thing at play here too, correct? That when a bank looks at this, they're going to look at the most recent year, but they're going to pay attention to the previous year. And when they calculate, value, and so it can't be completely out of whack with what the previous year revenues and cash flows produced.
There's no question, and one of the reasons for that is because the banks will look at the last taxable year as a third-party verification. These are what the numbers that reported to the IRS. If you're giving them your numbers for 2020, they're internal numbers. Generally, they're fine, CPA prepared, but they're still internal numbers. So the banks are required by SBA rules to go back to the last taxable year and make sure that the debt coverage is appropriate there, after allowing for a buyer's household household cash flow needs, as well as the prior year, but mostly the most recent tax year. So you just can't get too carried away with the internal statements.
Yeah. So my experience here is that if you own a business and you've experienced this sort of uptick, you have a couple of options. One, you hold on to it for another year to see if this is the new normal. And so if you have 2 years of this higher revenue and net profit performance, I think everybody could arrive at the conclusion that this is the new normal for that business. Or
yeah, I would agree.
If you have higher expectations and the buyer and the bank are uncomfortable, one of the other things you can do within boundaries, right, is arrive at an earnout potentially, so that if the business doesn't continue to perform at that level, the business value is ratcheted down to maybe the pre-COVID value or some value in between. Those are options.
Yeah, that is an option. And as we've talked about a number of times, in these SBA loans are wonderful for absorbing all the goodwill. They're not about collateral. It's all about cash flow, the small down payment, the long-term, all that. However, they've got rules. And for the banks to make sure that they're getting these guarantees, they've got to make sure that the deal fits the criteria. Historically, the banks and the SBA loans are not allowed to use earnouts per se is part of the purchase price.
Right.
However, as we've come to realize, you can build in a form of earnout by utilizing a seller note. Yeah. And have negative covenants triggered in the seller note that may reduce the purchase price if certain thresholds are not met. You can't have it out there as a regular earnout, as we all know, in the scheme of things. But under that kind of apparatus, you can adjust for what you're going to be paying the seller per the seller note downward if a revenue threshold or is not met, or employees leave, or whatever the trigger is. So you can get there. It's just a little different.
Yeah. And so for the audience, I just want to make sure that we're being clear here. You can agree to a slightly higher price or higher value with the ability to ratchet the price back if certain metrics aren't met. And typically those metrics are going to be revenue and cash flow. And I would urge everybody to get professionals involved in this, because it could be tricky. And even when you get to the legal language, it could get really tricky, because the last thing you want is to wind up in a lawsuit with each other over misunderstanding about the definitions of what had to happen to achieve this additional value. So, but the ability to derive additional value is there, with the ability for the buyer to de-risk if the revenues and the cash flows don't stay at those higher levels.
Yeah. You just get, as you said, you just got to be careful with the wording and make sure that it meets the criteria.
Yeah. So Doug, I know as part of the lending package that goes into this, the buyer has to come up with projections. That has got to be a bit tricky these days, sitting down and putting pen to paper and looking at projections. So tell me how you're working with folks on the projection side, and what are some of the things they need to be thinking about?
Yeah. So, I mean, the core principles of the projections in general are still hold. And that is, what are the expectations for the future that this buyer will be able to achieve in terms of revenue and cash flow based on the historical performance. Now, when you throw the wrench in of what is 2020 performance, that's where it gets tricky. And so you have to, we've had situations where banks have asked us to give them 3 versions of projections, an expectation, a high expectation, and a more moderate or lower expectation. Once you've got a projection done and you've got a spreadsheet, it's not that difficult to make different versions. But the banks will, want to look at that and say, well, what's the worst case scenario, so that they're making their underwriting decisions appropriately. Yeah. But the apparatus of doing the projections, along with the assumptions, and these are key. What are your assumptions as you do these projections? What are the reasons and the rationale of how you got to your numbers? So if you are going to do a projection for a business that's thriving right now, and you're putting it out at the numbers of revenue that you're seeing right now, then you need to explain why you think that's going to increase, why that's going to stay that way. And so the banks can get the comfort level to get to the same place you are as a buyer. Yeah. But you always have to, put the details in there, and, the expectations of what really is you expect it to be going forward. That's what we're talking about.
Yeah. And let me say, I'm going to put in a little plug here for you. You work with buyers and you help them through every step of this process, and it's invaluable. And for folks in the audience, understand, Doug is paid by the bank. It doesn't cost you anything to get Doug's experience. And so I know you've been through this hundreds, if not thousands of times. And I think, for the clients that we send you that work with you, this is invaluable. I mean, you can make or break whether or not they're going to get a deal done. And I think that's a tremendous service.
Well, thank you. Yeah, it's a lot of it is about the presentation. A lot of it is bringing out, all the things that the banks are going to be looking at and knowing what they're going to expect. And do you need a transferable management experience narrative, and what do you hit on, and those kinds of things to get the underwriters comfortable that this buyer can take over the seller's roles and effectively operate this business. And projections are a big part of that.
Yeah. So Doug, this has been awesome. As we wrap up here, any overarching comments that you would offer up to buyers or sellers or their advisors about, processing loans, getting through the loan process and values?
Yeah, I think that all of the things that we normally do are still important and still are the cornerstone to getting deals done. And you have to look at the cash flows of a given business and make sure that you have a comfort level, and we have a comfort level that the banks will see it the same way in terms of the coverage ratios and how much you feel you need to take out of a business, and then what the prospects for the future are. with these SBA loans, it is evident that the feeling among the SBA and the Treasury Department, or as what it will be going forward, is that there will still be hopefully some stimulus out there. And whether we get a CARES Act 2 or whatever the next step is, the hope is that maybe they'll reintroduce the 6 months of SBA payments. They've talked about increasing the guarantee for the banks, which is now at 75% up to 90%, to encourage them to lend even more, because everybody knows how important our small businesses are to our economy. They've talked about waiving the SBA fee. All these deals, the SBA deals, while they're great in so many ways, they do have a fee, and that's 2.5% to 3% of times 75% of the loan amount. Gets bundled into the project cost, so it's not too painful. Yeah. But on a larger deal, on a $5 million deal, that's over $100,000. Same with 6 payments being made for you on a $5 million deal, that's over $100,000. So yeah, these things have real meaning. Yeah. So hopefully, some form of that will continue. And the SBA world, the lending world for acquisitions is really doing pretty well. And these banks are lending, and they've tweaked the process a little bit, but financing is out there. And if the numbers work, and you've got the experience and reasonably good credit and the money for a down payment, those deals will get approved.
Yeah. And Doug, I'm just curious, I know rates are, dependent on the bank and your credit history and all that sort of stuff, but where are rates right now on an SBA loan? What's sort of the band right now?
So the highest rate that a bank can charge in the SBA world is 2.75 over prime. Yeah. So that'll put you at 6% today. Yeah. Most of the deals are variable. We see some fixed opportunities here and there. And then the rate will go down from there depending on the strength and the size of the deal. And so, if you're looking at a $500,000 business acquisition, you're probably not going to get too much lower than 5.75 for your rate on a 10-year loan. If real estate's involved and you have a longer loan, because you can go up to potentially 25 years, the banks are generally willing to come down a little bit on the rate when real estate's involved. If you've got a $2-3 million acquisition and a nice situation where the buyer has the proper experience and the cash flow is good, I would think that you should be able to get down to 5.25, maybe 5%. But I would say that's pretty much the range. The typical deals in today's world are going to be between 5 and 6%.
Got it.
With some specials that are out there for some banks who will want to get more business, especially with real estate, and might come down below 5 every now and then. But I think realistically speaking, that's where you should expect to be.
Got it. Yeah, those are great rates.
They really are.
Yeah, I mean, that gives you a lot of leverage on deals with pretty low debt service potentially. And again, the 10-year term on an SBA loan makes it incredibly attractive.
Well, no question, and there's no prepayment penalty. So these loans are a wonderful tool for acquisitions. With 10% down, I mean, you can't touch that in the commercial world.
Right. Yeah, without a doubt. Hey, Doug, this has been awesome. Really appreciate you being here. If folks in the M&A Unplugged community wanted to get in touch with you, how could they reach you?
So you can call me, 773-368-9611 is my mobile number. I have it with me most of the time. Or email me at dadams@𝐬𝐮𝐬𝐜𝐫𝐢𝐻𝐻.com.
That's awesome. I love leading with the old school phone number. Just let's get on the phone and talk about it. That's great.
It works well.
Doug, thanks for being here. Really appreciate it.
All right. Thanks for having me. You take care.
I hope you enjoyed today's episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.